the net present value test and how that is done. We're going to focus today, at least to start, on the other Making Home Affordable programs that are available. As we talked about previously, the Making Home Affordable program was rolled out about 4 years ago, and originally it just had the HAMP Tier 1, what is now HAMP Tier 1 program as part of it. As time went on, the Treasury Department, the Obama administration, responded to market conditions, responded to where the program was not working as well as they hoped it would be, and they expanded the MHA program to incorporate some more plans. The first of those we're going to talk about is the HAMP Tier 2 plan. HAMP Tier 2 went into effect, as you can see, on June 1st of last year. The goal was to expand HAMP to allow more homeowners to qualify for that program. So under the HAMP Tier 1 program, your DTI, your debt-to-income ratio, had to be above 31% to start. Under the expanded HAMP Tier 2 program, that lowers that rate, that DTI ratio, so that you can be a little bit lower and still qualify into a Making Home Affordable program. It's also open to rental properties. The HAMP Tier 1 traditionally had not been open to rental properties. And it also is open to those rejected from the HAMP Tier 1 if you failed the NPV test, or, as you may recall, we talked about the fact that if you get a HAMP Tier 1 trial plan, and then you made a payment or 2 payments, and you fell off it, that was your only shot at HAMP Tier 1. There's not a second bite at the apple. However, if you had fallen off of a trial period plan under HAMP Tier 1, you can qualify for a HAMP Tier 2 modification. So again, it gives people another chance to modify that loan in such a way so that they can remain in their house. There are some differences here as far as how the loan gets modified. And I want to go through those here with everyone. So you can see on the left side is the HAMP Tier 1 waterfall. We went through this last time, but essentially there's 4 steps. The first is to capitalize all of the missed payments, taxes that were paid on the homeowner's behalf, anything that the servicer had paid out on the homeowner's behalf. Capitalizing that, meaning adding all of those onto the unpaid principal balance. There's then a reduction in the interest rate that gets reduced by 1/8 of a percentage point at a time in trying to get that debt-to-income ratio down to 31%, dropping all the way down to a rate of floor of 2%. If it still hasn't reached that 31% mark, you then extend the term out. You can go as far as 40 years. And if that still hasn't reduced that ratio to 31%, there is the interest-free balloon payment that can be set up. Again, the goal of the program under Tier 1 is to get you to a 31% ratio. And so you're going to take whatever steps in the waterfall that are going to be necessary to get you to that 31% ratio. Under HAMP Tier 2, it's a different story. The first step is still the same. There is that capitalization. So again, you're going to take all of the missed interest payments. You're going to take taxes and insurance the bank may have paid, any costs that are associated with if there is a pending foreclosure. Those are all going to get rolled in so that the homeowner, the idea is that when the homeowner has all those capitalized, the homeowner can be current again. They don't have any past due payments that are owed. So that first step is still the same. But the next step is different. Under Tier 2, everyone under Tier 2 will get the same interest rate. The interest rate is set at the risk-adjusted primary mortgage market survey 30-year rate. That is if you want to look that up on the internet, it's risk-adjusted PMMS. If you Google PMMS, it will come up. Primary Mortgage Market Survey. Currently, as of July 18th, that is 4.37%. So you take that interest rate, you round it up to the nearest 1/8 of a percent. That's going to be the interest rate that the people are going to have. All right. It's not going to be a different interest rate for each homeowner. It's going to be the same regardless. You then are going to extend the term out to a new 40-year term. Again, that happens for every HAMP Tier 2 modification. So the interest rate is set, the term is a new 40-year term. At that point, you then look to see, has the homeowner's payment dropped by at least 10%, their principal and interest payment? That must be the case. If there's not a 10% drop in the principal and interest payment, the homeowner will not qualify for a HAMP Tier 2 modification because there's not enough of a drop in payment. Also, the post-modification debt-to-income ratio, the one we talked about before, that under HAMP Tier 1 they're trying to get you down to 31%. Because of the fact that everybody gets the same interest rate, everybody gets a new 40-year term, people's debt-to-income ratios are going to be different after a HAMP Tier 2 modification. They're not all going to be 31%. The post-modification DTI ratio has to be between 10% and 55%. If it falls within that range and there's that 10% principal and interest drop, the homeowner qualifies for HAMP Tier 2. If not, if it is not within that 10 to 55% range, or there's not a 10% drop, it is then the discretion of the servicer as to whether they offer it or not. My understanding is, from what I've seen, is that servicers will not offer it if the homeowner doesn't fall into that 10 to 55% range and the 10% drop. So those are really the hard and fast rules for HAMP Tier 2. Next MHA program that's available is the Principal Reduction Alternative. The idea behind the Principal Reduction Alternative was that you had a lot of homeowners that were very underwater, depending on obviously what part of the country you're in, what region, even what city, how the housing market, the boom and the bust affected different parts of the country differently. The idea behind the HAMP modification, the traditional Tier 1 modification, was to bring your ratio down to 31%. But what that did not do was solve the issue where people owed huge amounts more than the house was worth. So the Principal Reduction Alternative is one tool that can potentially help solve that problem, or at least minimize it. Now, the Principal Reduction Alternative, not every servicer that is signed up to be part of the HAMP Tier 1 also takes part in this Principal Reduction Alternative. It is a separate program that these servicers signed up to be a part of. So again, you want to make sure you check the HAMP website to find out exactly which programs a servicer takes part in. They may take part in just HAMP Tier 1 and HAMP Tier 2 and not the Principal Reduction Alternative. It does not necessarily have to be that way. So it's important to look and know what the servicer is taking part in. Now you see on your screen the difference between the HAMP Standard Waterfall and the Principal Reduction Alternative Waterfall. There is really only one difference, and that is step 2 on the Principal Reduction Alternative Waterfall. So again, the first step is to capitalize all those missed interest payments, taxes and insurance that were paid, so you have a new principal balance that the homeowner is dealing with. The difference for the Principal Reduction Alternative is that the first thing you do after that capitalizing is you're going to look at the unpaid principal balance and compare to see if the loan-to-value ratio is where that's at. So if you have a house where the house is worth $100,000, the homeowner owes $125,000, that loan-to-value ratio would be 125%. The goal of the Principal Reduction Alternative is to bring that down to 115%. So in the example I'm using, you would be looking to reduce the principal balance from $125,000 down to $115,000. So there'd be a $10,000 principal forgiveness. This is different from under the standard waterfall. When you get to a balloon payment, you have an unpaid balloon pay, or a interest-free balloon payment, but the homeowner still has to pay that at the end. They may be interest-free, but they still are on the hook for paying that. Under this Principal Reduction Alternative, it is actual principal forgiveness. Once you've reduced that unpaid principal balance to loan value ratio down to 115%, the rest of the steps remain the same. You're going to reduce the interest rate down at an eighth of a percentage point at a time with a floor of 2%. Again, you're trying to get down to that 31% ratio of debt to income. If there is principal reduction, so if you have, in the example I had, there, you're taking the principal down from $125,000 to $115,000. You've had $10,000 of principal forgiveness. The way that it works is that that's going to be forgiven over the course of 3 years. Each year that a homeowner completes their 12 payments, at the end of that year, they will have a third of the principal that is going to be forgiven. So in the example I used, after a year of payments, the homeowner would have $3,333 forgiven of principal. Again, that same thing would happen after the end of year 2, and again at the end of year 3. So after 3 years, any principal that was going to be forgiven under this program will, in fact, have been forgiven. Now, let's say even a case where the homeowner owes a significant amount more than the house is worth. So let's say the homeowner, the house is worth $100,000, but the homeowner owes the bank $200,000. There is a limit on how much principal balance can be reduced. The servicers are never required to reduce more than 30% of unpaid principal balance, regardless of where that will leave the unpaid principal balance to loan value ratio. So in the example I used, if you owed the house worth $100,000, you owe the bank $200,000. The most they would have to reduce that principal balance by is $60,000, which is 30% of the $200,000 unpaid principal balance. So in that case, it would bring the unpaid principal balance down to $140,000, still higher than the 150% ratio, but the idea being that servicers under this program, they're not going to force them to take 50% cuts in what that principal balance is, regardless of how we feel as advocates on behalf of our homeowners that it should be. And currently, that's the status of the program. Now, if you do have principal reduction, there are potential tax implications, because any principal reduction is considered debt forgiveness, which is considered in ascension, it's considered income. Therefore, if you have a homeowner that's dealing with that, it's very important that they reach out to a tax person when it comes to filing their taxes. There is right now there's mortgage forgiveness potential. There's the Debt Relief Act of 2007 that is set to expire at the end of this year, the end of calendar year 2013. It has been extended in the past, but it's unclear whether or not it will be extended again. If it is currently, the way it stands is that there is the ability for homeowners to have an exemption for that initial debt forgiveness, and so they should not have to pay taxes on debt that's forgiven. But again, I think it's really important that if you have a homeowner that's in that situation, you let them know that they should be reaching out to their tax person or an accountant or a tax person when they go to file this year's taxes, because the last thing you want to do is see somebody get in a situation where they do have a tax situation as a result of the principal forgiveness. A couple other MHA programs I want to touch on. The Home Affordable Unemployment Program. This is a program, as you can see on the screen. It gives homeowners that are unemployed a forbearance plan. It's available for non-GSE loans, so that's non-Fannie and Freddie loans. There are similar programs available for Fannie and Freddie loans as well, but this is specific for the non-Fannie Freddie loans under the Home Affordable Unemployment Program. The homeowner, there are some requirements. The homeowner has to either be about to receive or already receiving unemployment benefits. What the payment is going to be is it's going to reduce their payment down to 31% debt-to-income ratio. At a minimum, servicers can go even further below that. Some servicers have gone down to, in fact, a $0 payment, but that is at the discretion of the servicers. What they must do is reduce the payment to at least 31%. If you have a homeowner that qualifies for this program, it is going to last a minimum of 12 months or until that homeowner is reemployed. This is a relatively new program. We have not had a lot of people through our offices that have taken part in this program, but I do think it's important that you at least know it is available out there. The last two programs that are under the MHA umbrella, I'm going to touch on very briefly. The first is the Home Affordable Foreclosure Alternative Program, known as HAPA. This program, the last I checked, had only had 126,000 people take part in it since the program was started. So it has not had a huge impact. However, this is for folks that do not qualify for a HAMP Tier 1, a HAMP Tier 2, or any other sort of loan modification program, and they're looking to get rid of their house. And so this is a way to either do a short sale, a deed in lieu. There are some potential cash kickbacks to the homeowner if they take part in that program. Again, not a huge amount of people have taken that program up. And then the last one is the second lien modification program. This was put in place so that because we have homeowners that have two mortgages out there, HAMP Tier 1 and HAMP Tier 2, in the principal reduction alternative, only focus on your first lien. So they do not adjust the second lien at all. In fact, when you're looking at the debt-to-income ratio, you're only calculating in the first mortgage payment. You are not supposed you cannot add in the second mortgage payment. So for people that have a very onerous second mortgage, HAMP Tier 1 and HAMP Tier 2 may not be enough to get them the relief they need. So a program was put in place to work for homeowners that have a second lien and for servicers that are servicing that second lien. Unfortunately, this program has been the least utilized of any of the programs. Currently, there's been only about approximately 100,000 done nationwide compared to the number of HAMP Tier 1, Tier 2, principal reduction alternatives. It's a very small number. We have not actually had, I don't believe we've had anybody in our office that has taken part in the second lien program. But again, it is out there. Again, it's one that servicers can decide if they want to take part in or not. So you want to check the HAMP website if you are interested in seeing if a servicer is offering that program, if in fact they've signed up for it. That's the universe of MHA, the Making Home Affordable. What I'd like to focus on now is non-MHA programs. And that's going to include FHA, VA, and then non-GSE loans. So for FHA insured loans, as I'm sure most people on the call know, if you have an FHA mortgage, that is something you get when you get your mortgage. You will have an FHA mortgage. If it is an FHA mortgage, there are certain loss mitigation opportunities that are available. Their program is a little bit different than the traditional Fannie or Freddie or non-GSE loans, where HAMP would be typically the thing you'd look at. For an FHA insured loan, there are a number of steps you're going to look at. As you can see on this screen, it goes from the informal forbearance plan, that is the least onerous, all the way down to FHA HAMP. The way that FHA is supposed to look is they look at first to you for a homeowner if they can qualify for the informal forbearance plan. Then they look at the formal forbearance plan. Then they'll look at loan mod, and then they'll look at FHA HAMP. And we're going to go through each of those here, hopefully to add some meat to the bones here. Informal forbearance plan, let me go back to that first. This is an oral agreement. It's for a period of 3 months or less. This is a case where oftentimes a homeowner has fallen behind only by a couple months. They call up on the phone. They say, no, I can make those payments up. I don't need long. Let's just spread it out over a couple months, and I'll get back to current. Typically, we do not seek the homeowners that we work with typically are not ones that can fall into the informal forbearance plan. By the time they have reached out to us, they are much further behind, and they don't have the kind of surplus income that allows them to catch up in a period of 3 months or less. But that is the simplest and easiest plan under the FHA in the FHA world. Formal forbearance plan is a little bit different. This will be one that lasts 4 or 5 months. It's one or the other. FHA is very specific about that. This is the option if a homeowner has 85% of their surplus income will bring the mortgage current within 6 months. So essentially what that is saying is the homeowner has a lot of surplus income. Even after paying all of their other bills, paying their mortgage, their current mortgage monthly payment, they still have enough money left over every month to make a significant dent into whatever their arrearages are. The case where you may see this is somebody that gets a commission or a bonus check, and all of a sudden they've got a bunch of money that they're able to throw at the arrearages and can solve that quickly. Again, not something we typically see with the clients we deal with because they just don't have the kind of surplus income that would allow them to bring that mortgage current within the next 6 months. Special forbearance plan is a little bit different. A special forbearance plan is a plan that is available for homeowners in the FHA world that are unemployed. So this is a written agreement to reduce or suspend the mortgage payments entirely. It's going to bring that payment obviously down a lot, maybe even down to zero. But it's only available for homeowners. It's available for homeowners that are 3 months or more behind. So again, this is only for unemployment. If you're not dealing with a homeowner that's unemployed, this special forbearance would not apply. Next thing you'd look at, if none of these work for the homeowner, they don't qualify, is what is the FHA Loan Modification. And I think that there's been a fair amount of confusion out there regarding FHA Loan Modification and FHA HAMP. There were changes to the FHA world last November, and that's what created this whole process that FHA now works on. Previously, there was a requirement that said if you were more than 12 months behind on an FHA loan, they could not do any loss mitigation efforts until your homeowner got caught up to at the most 12 months behind. So for instance, if you had a homeowner come in that was 2 years behind, they would have had to have made 1 year's worth of payments right off the bat in order to just qualify for any of the other loss mitigation options under FHA. That requirement is no longer there. So a homeowner can be much further behind and still qualify for some sort of loss mitigation, which is a very positive thing in the FHA world. But, excuse me, the process that has been created, there's a lot to it. So I want to go through each of the different things that are necessary for a loan modification. Hopefully this will make a little more sense as we go. So you can see here the criteria that a homeowner must meet in order to qualify for an FHA loan mod. The first is the loss of income or an increase in expenses. That is very simply that they have to show a hardship, which is the same as really under any of the programs we've talked about today or in previous webinars. Currently employed, if the homeowner is not currently employed, then they'd be looking at a special forbearance agreement. Obviously, they wouldn't have income at that point, so that's important. Surplus income greater of $300 or 15% of net monthly income. What that means is that the homeowner has some sort of cushion in their budget. That's going to be a big one. We're going to talk about that again when it comes to the FHA HAMP world. But so remember that they do have to have income, surplus income, of greater of $300 or 15% of their net monthly income. Next bullet point is that 85% of their surplus is insufficient to cover the arrearages in 6 months. Now, if you'll notice, that is the opposite of the language under the formal forbearance plan. So under a FHA formal forbearance plan, it would be if the homeowner could use their surplus income to get current within 6 months. If you can't do that, if you don't have enough surplus income to get current within 6 months, you therefore be looking at the FHA loan modification world. In other words, you don't have enough money to make up your arrearages very quickly. It's going to have to be a longer-term solution. That's when the loan mod comes into play. The next bullet point talks about the fact that there is the monthly pity payment has to be reduced by the greater of $100 or 10% of the monthly payment. The idea behind this is that doing a loan mod in the FHA's mind has to create a real difference for that homeowner. So if their payment doesn't drop by at least 10% or $100, whichever is greater, FHA feels it's not worth it. We've not made enough of a change in the circumstances of this homeowner that there's a realistic chance that they're going to be able to make these payments and continue to make these payments into the future. Now, the second half of this states that it's got to reduce debt by setting the interest rate at the market rate and amortizing to 30 years. What they're going to look at is under the terms of the loan modification, is that payment going to be reduced by 10% or at least $100? We're going to talk in a second about how that's done. Next bullet point, again, just like in the HAMP world, you'd have to complete a 3-month trial plan. The FHA wants to make sure these homeowners are serious about it. They're actually going to make their payments. They're going to make them on time. If you do that, then it gets converted to a permanent modification. The last bullet point also I think is very important. You cannot have had a previous loan modification within 2 years. I know, having talked to some of the local housing counseling agencies here in Rochester, that this is a sticking point for a lot of people. A lot of people that would otherwise qualify cannot qualify because they were in a loan modification and they fell off it within the last 2 years. Unfortunately, I don't think there's any wiggle room in that. That is a black and white rule. So unfortunately, it is going to probably cost some homeowners the chance to qualify for an FHA loan mod because they've fallen off a plan previously. Now,
Kevin, I have a couple of questions that I think now is a good time to ask.
Great.
So the first one is the $100 off the payment really considered a real difference? Seems very minimal.
The short answer is, in the FHA world, in the FHA's eyes, yes. $100 is, that's what they have picked as the real difference. Now, I certainly think that those of us on this call today could have a very good debate about what the dollar amount should be. One of the things that we've tried to stress in these webinars is a very practical nature of these webinars, which is whether or not we agree or disagree with the rules that are out there. This is really meant to be simply to give people the tools to know what is out there. And I certainly think there's room for debate as to whether or not $100 is enough or not. But the short answer is yes, that is the rule.
Okay. And then the other question has to do with HAMP Tier 2. And if maybe you can go over the debt-to-income ratios and how they apply. So the question is, at first we talked about a range between 25% to 42% DTI, and then there was a discussion of a range between 10% and 55% DTI. Where do these ranges apply?
Sure. Let me do this. Let me finish off the FHA loan mod portion, and then I'll go back to the HAMP Tier 2.
Perfect.
Just because we're on this screen right now. So my understanding for FHA loan modifications, and again, this is a relatively new, it was changed last November. We've just started to have some of our clients here at Empire Justice Center go through this process. My understanding is that if a homeowner could qualify for an FHA loan mod, they've passed these initial bullet points that we just laid out. The information is then sent from the servicer to FHA, and FHA comes back and tells the servicer, here's the terms that this loan will be modified under. It may include interest rate change. It may include an extension of the term. But it doesn't have to. So, for instance, I had a homeowner that qualified for an FHA loan modification, and there was no change in interest rate whatsoever. They re-amortized to a new 40-year term, but they would not adjust the interest rate. We are still in settlement conference in that case, and we're still trying to fight to understand why there was no interest rate reduction. But my at least initial understanding is that FHA gets to dictate the terms of the loan mod. There is no set waterfall test they have to follow. It could be different depending on each homeowner's situation. So, for instance, the homeowner that I'm talking about of ours has a lot of equity in their house. And so my understanding is FHA essentially said, listen, there's no need for us to adjust this interest rate for this person. We'll re-amortize, but that's all we're going to do and set this up as a new 40-year term. So what terms are going to come back is dependent on the homeowner's specific situation. Again, if any has different experiences with FHA loan mods recently, I'd love to hear about that, but that is my understanding of how this works. Now, let's go back real quickly to the HAMP Tier 2. Okay, so we talked about the fact that under HAMP Tier 1, one of the initial tests for homeowners is that their debt-to-income ratio has to be above 31%. The whole idea of the HAMP Tier 1 is to reduce that debt-to-income ratio from whatever it is down to 31%. HAMP Tier 2 expands the universe of people that could qualify for a HAMP modification. That initial DTI ratio, which for HAMP Tier 1 has to be above 31%, for HAMP Tier 2, it can be, my understanding is it could be anywhere between 25% and 42%. To start with. So if you try to if you're a homeowner that is looking for a HAMP Tier 2 modification, as long as their initial DTI is between 25 and 42%, they're going to pass that initial test and be looked at for a HAMP Tier 2 modification. Now, once the HAMP Tier 2 modification is completed and you have a new payment for that homeowner, you need to look, the servicer will need to look at what the new DTI ratio is. That new DTI ratio, after the payment has been modified, must be somewhere between 10 and 55% DTI ratio. So there's two separate sets of numbers there, but hopefully that makes sense to people. Okay, going back to the FHA world. So we've talked about FHA loan modifications. If you do not qualify for an FHA loan mod, the next thing to look for would be the FHA HAMP. FHA HAMP, there are three different varieties of FHA HAMP. There is the FHA standalone partial claim. There's the FHA standalone HAMP loan modification. And then there is the FHA partial claim with loan modification. Those are all FHA HAMP, three different types of FHA HAMP programs. Partial claim, I want to go through this, and people that have had some experience with FHA partial claims have been around for a long, long time. The idea behind a partial claim is essentially you're setting up what is akin to a second mortgage. So you're going to take the arrearages, all those missed payments we've talked about, missed interest payments, taxes, insurance, all those back due payments that are owed to the bank. And what a partial claim does is essentially carves that out and makes that into akin to a second mortgage. What it allows is the homeowner then to be current on the first mortgage, on the main mortgage, because you've now taken all those off, so they don't have any past due payments due. And that partial claim is going to be treated as a interest-free, essentially an interest-free balloon payment that's going to be due at the end of the loan. So interest doesn't get charged on it. The homeowner is going to be responsible for paying for it, but they're not going to have to pay for it until the end of the loan, either when they sell the house, they refinance, or the loan comes due. And again, they're not going to have interest charged against them through, on that. That's one way to deal with those arrearages, is to carve out all the arrearages and turn them into a partial claim. The second thing would be a standalone loan modification. In the FHA HAMP world, they do look to the traditional waterfall test. So it's not the situation where, as I talked about a few minutes ago, under the FHA loan modification world, where FHA gets to decide all those terms on their own. Under an FHA HAMP modification, they do have to go by the traditional waterfall test we've talked about. The last of these would be a combination of the two. So you'd have a partial claim and you'd have a loan modification. Again, each of these programs are slightly different. The big difference for when a homeowner will look at an FHA HAMP versus when a homeowner will look at FHA loan modifications would be the surplus income. Go back to this last screen I had. Right here, this bullet that I talked about. The 85 or the I'm sorry, wrong one. This one right here. Surplus income greater of $300 or 15% of net monthly income. If your homeowner has surplus income that is not greater of $300 or 15% net monthly income, so they do not have much of a surplus at all, they don't qualify for the FHA loan modification. This one right here, sorry. So if the homeowner does have greater of $300 or 15% of their net monthly income, they're going to be looked at for an FHA loan mod. If they do not have greater than $300 or 15% of their net monthly income, then they're going to be looked at for FHA HAMP. That's the big difference. So if the homeowner has really no cushion at all, they are really razor thin as far as the surplus in their budget, that's going to be what sends them to the FHA HAMP world as opposed to the FHA traditional loan mod world. In the FHA HAMP world, there is not an NPV test as there is under the traditional HAMP world. So the homeowners, there is no NPV test. All right, I want to look now to the VA world, VA insured loans. Again, very similar to the FHA world in that you've got a repayment plan, you've got a special forbearance for unemployed homeowners, you have a traditional loan modification, and you have a VA HAMP process as well. The first three of those are similar. Repayment plan, special forbearance, traditional loan modification. They are very similar to the FHA world. The VA HAMP is a little bit different. I want to talk about it very briefly. Again, you're going to look to calculate a targeted affordable payment, and that is supposed to be targeted at 31% debt-to-income ratio. Estimate the modified loan balance, the modified loan terms, and then what the VA documentation states is that the servicer is supposed to determine feasibility of a HAMP-style modification. Now, that is very vague language. Our office, we have not had anyone go through a VA HAMP modification, and I haven't talked with anybody who has gone through this. So this is more on a theoretical basis from our perspective at this point. From what I understand, servicers do not have hard and fast rules when it comes to creating a VA HAMP-style loan. Again, if people on the call have experience with that, I would love to hear from you to hear how that process went. But the important thing, at least for this call that I want to make note, is that if you do have a homeowner who has a VA loan and they are behind, there is a VA HAMP-style package that should be available. And so at least make people aware to know to ask those servicers if that is available, and if so, how that works. And finally, for non-GSE loans, again, this goes for loans. They could be with servicers that take part in HAMP, but the homeowner doesn't qualify for HAMP or for HAMP Tier 1, HAMP Tier 2, any of the Make Home Affordable programs, or it may be for a servicer that doesn't take part in the Make Home Affordable program at all. In those cases, either case, the servicer bank can still offer a loan modification to your homeowner, or some sort of a loss mitigation opportunity. It just wouldn't be under these national programs. So they could offer a short-term forbearance plan. We oftentimes have homeowners that receive 3-month and 6-month forbearance plans. Oftentimes that's health-related issues that either reduce or eliminate their payment. that is not going to permanently change the terms of their mortgage, but may give them some short-term relief to get them over the hump if they've got a short-term issue. There's also the traditional repayment plan, and we have cases where homeowners will make a lump sum payment up front, and then over the course of the next 12 months are going to plan on catching up on all their arrearage. This is also something that comes up often for us for tax liens. We have had here in Rochester, both the city of Rochester and the county that we're in, Monroe County, have signed a deal where they sell off their old tax liens to third-party companies. They have two companies down in Florida that they use, the first of which was American Tax Funding, which I believe has done this as well in other parts of the state. So in cases like that, if you have a homeowner that has a tax lien filed against them, a tax foreclosure, oftentimes they are not going to be able to work anything out other than a repayment plan, and so that's something we see there as well. And then the last is what used to be considered a traditional loan modification, and that's an in-house modification. So any servicer or bank could come up with any terms that they want to for an in-house modification. Really, the limit is just their imagination. And as some people on the calls have seen, the banks can get quite imaginative with some of these loan modifications. Now, that can be good or bad. In the past, we had cases where, before HAMP was available, where homeowners were receiving modifications that really didn't do anything substantively to help the homeowner out. So the homeowner had a 9.85% interest rate, and their new interest rate is now 9.62. Not much of a difference there. Then their payment's going to stay the same. The bank may have taken all those payments, the missed payments, arrearages, and spread them out over the course of the remaining years of the loan. So it did get the homeowner back to current, but their payment has now shot up through the roof. There's no limitation on what the banks can do. Well, I shouldn't say no limitation. There are not a lot of limitations as far as what the banks can do within these in-house modifications, and it's up to the homeowner whether or not they want to accept the terms that are being offered. Again, these are going to be different regardless of what bank you go to. Each banking or servicer can come up with their own terms, so it's not something where we can provide a lot of guidance as far as what you're going to see, but that's always still an option if a homeowner doesn't qualify for any of the national programs that have been set up. Before we move on to the, and we're only going to have a couple minutes, and I'm going to start on the loan modification documents, the modification denials, and escalations. I want to take a minute if there are any questions regarding what we've talked about so far, because it's a lot of dense material that I know we've gone over. Right. Michelle, is there a way to open up the phones for questions if people want to ask them live rather than typing them in?
Devin, we have a couple of questions first. I'd like to address those.
Okay, perfect.
So the first one is, if a homeowner receives a HAMP modification, will he automatically be reviewed for his second mortgage under the second HAMP, the second lien? That's
a very good question, and I will confirm this, and we will be able to send out follow-up answer via email to everyone. I believe that they should, if the second mortgage servicer is taking part in the program, I believe they should be automatically reviewed for that 2MP program, but I will confirm that and send in a confirmation email to folks on the call regarding it.
Yeah. We have two other questions. One, I don't quite understand the question, but the other one is advice, I suppose. Client has already had one loan modification. Her income is $2,400 a month when she got into the loan mod. The payments shot up to $1,700, which clearly are not affordable on her $2,400 a month salary. Are we better off trying to get her into a HAMP program, or should we be looking at a forbearance?
So the homeowner makes $2,400 a month,
right?
And under a in-house modification, they want to raise the payment to $1,700. Is that correct?
It's unclear. It's
okay.
Unclear.
I would say in that kind of a case that my take is that the HAMP modification is always the first thing I'd like to see a homeowner that I'm working with get into, because I think the HAMP program, what it does is it'll lock in an interest rate long-term, so it gives some long-term solution to the homeowner. And, of course, it's going to reduce that payment to 31%. So if she's making $2,400 a month, the 31% would put her at approximately $820 or $830, about half of what they're asking her to pay, the homeowner to pay right now. So I certainly would want them to be reviewed for a HAMP modification. Now, and they wouldn't under that situation. A special forbearance plan, again, is only for those that are unemployed. I think, based on those facts, that homeowner is in fact it does have an employment. So I don't think they would qualify for a special forbearance plan in that case anyway. But yes, I would say HAMP, being reviewed for HAMP would be the best situation for that person right now.
Right. Okay, and then the other question, Kevin, I don't know if you can see it. The first two questions is on your panel. The one about are the banks giving snowball in summer? I don't quite understand those two questions. The second one's a clarification of the first. Maybe you can.
Are the banks giving snowball in summer to the homeowner under this reduction of mortgage?
Yeah, I'm not sure what that means. The second one,
Clarification.
Regarding what the bank's reducing the original from Joe?
Yes.
Okay. So the question is, the banks seem to reduce it if there's a principal reduction, that the banks are still recouping their original investment. And that is very much true. If any principal reduction that is done, the banks are going to get a kickback from Treasury for a portion of what they reduce. The highest, I believe it gets up to, is 50% of what they reduce, they will get reimbursed. So while the banks do take a hit, the hit is not as large as it could have been if they were not part of this program. Again, I know we talked about this on the last call, the fact that these programs were set up with a dual basis, at least in my mind. Part of it was to provide relief to homeowners, but certainly part of it was to provide relief to the mortgage servicers and the banks. And whether or not you consider that right or wrong, I think is indisputable that with all of the incentives that are there for the banks, this program is not just for homeowners. It is also to help the mortgage industry become stabilized. And again, we can have a debate whether or not that's necessary or whether it is tipped the balance one direction or the other towards homeowners or towards banks. Again, from a practical perspective, I don't know, as far as applying these programs, how much it matters. But there is definitely a kickback to the banks for any time they take part in any of these programs, and certainly as part of that for the reduction in principal. Now, I think that it probably makes sense. We are going to have one more webinar at some point in the near future, and that's going to cover everything that happens if you get a loan modification, kind of all the problems that can come up from the time you're offered the loan mod until a permanent loan mod has been signed and is in effect, the things that you need to look out for your homeowner, some of the tricks the banks and servicers will play after a loan mod has been offered, and also how to escalate if you get denied a loan mod and you feel that this homeowner has been denied wrongly. What's the way to escalate? What's the way to get some satisfaction at that point? That's going to be the topic for our last webinar on this overall topic. So I think this is a good time to break and to stop this one. Again, if people have questions and we didn't get them answered here, please feel free to call or email me. My email is on the last slide here. Hopefully we can go to the end real quick. There's my email address and my phone number. Please feel free to call me if you have questions about either what we've talked about today, or if you start working through some of those. You have a client that's in, an FHA mod, and you can't figure out exactly what has happened. I will do my best to help you any way I can. So please feel free to give me a call. So I think at this point we'll And Michelle, is there anything that needs to happen at your end?
Kevin, we still have a couple of questions. I think we can probably...
Okay. Let's answer more.
So one is a policy. I might sort of tick some of these off for you if that's okay.
Yeah.
Why is there NPV in the FHA HAMP? That's more of a policy question that we don't really have the answer to, unless, Kevin, you've got something wise to answer on that?
No, I have no wise words on that one.
Okay. And then, do the banks have a choice to say that principal reduction is non-taxable? The short answer to that really is no, that that's an IRS determination, and whether or not income is taxable has nothing to do with the bank. However, the long answer, which I'm not going to be able to get into, is if this is litigated, there are ways to navigate around that and to avoid that completely and get it outside of the scope of the IRS. But the short answer is that the bank does not have a way to deal with that. If you want to try to deal with that issue, I would talk to a tax attorney, frankly. There are ways to deal with that in terms of the litigation aspect of it. And then the next one is my homeowner received an in-house mod where the interest of 7% was the same before they extended it out to 40 years, and they will pay more. I think that's what I'm reading. Is there any chance she can get a second HAMP, the second lien, reduced if it's a non-GSE loan?
Gladys, I'm not entirely sure on that one, but I will contact you directly so we can talk through that one, because I honestly don't know the answer to. I'm not sure I understand exactly the details of the question. So Gladys, I'll reach out to you directly to see if we can talk through that one.
And then Joe offered an answer to the principal reduction and then the taxable question. He says that bankruptcy is the answer to get the deduction and no 1099. Yeah, so bankruptcy is a solution if it makes sense for your client. It doesn't make sense for every client to file a bankruptcy if they've gotten the principal reduction. But for some people that can be an option. But it's not a solution for everybody. All right, those were the questions that I have here. And that's for about 1 o'clock right now, right?
Yes. The CLE code has already been up there, or what? I just want to make sure that for people that want to get.
Yep, it's 16723.
Great.
Kevin, anything else you want to add?
That's it. You know, look for. We'll be sending out an email with the date for the last of the webinars for this. As you all know, we have several webinars. We have 2 webinars every month. And hopefully people can take advantage of those. We try to make them as useful and relevant for folks as possible. So thanks again for your time today.
All right. Thank you. Thank you, Kevin. Thanks, everybody.
Okay. Bye, everybody.